Hello and welcome to Gold and Silver Assets. It's Sunday the 17th of November 2019. So today we're going to look at the bullish case for gold and whether this is actually realistic. And the reason for talking about this is that we've had some comments from previous videos which make some excellent points about a possible bearish scenario for gold. And some of these points are based on some fundamental factors. So of course there are multiple factors that do affect the gold price in different ways. So we're going to start by looking at some of these. So one of the factors is interest rates. So this is a chart showing the gold price in red versus the Fed funds interest rates. And it's interesting to see that there's not actually any clear pattern here. The theory is that interest rates go down and that causes gold to rise, and that has been true in some areas. So for example, over here you can see interest rates have gone down and gold has risen. But then again here, interest rates have been flat, whereas at the same time gold has actually gone down. And if we go back into the 70s, interest rates shot up, but so did gold. So there's not a clear correlation there, but of course it's not just the Fed funds rate that we need to look at. We've also got to think of things like the real interest rates, and that's of course intertwined with inflation. There's also talk about negative interest rates, and if this happens, in theory, that could be good for gold. It's of course much better to have a zero yield than to have a negative yield. But on the flip side, what if people go and put all their money in the stock market because, you know, with the hope of a positive yield compared to zero or negative yield? And of course that would be negative for gold. It's very difficult to know what the effect of negative interest rates will actually be because it's never actually happened on a global scale. What about looking at the stock market versus gold? So in theory, people say that if there's a stock market crash, then that causes margin calls, and so people sell their gold, and that leads to a decrease in the gold price. And often cited is this 30% drop in gold during the market drop in the 2008-2009 period. But if we look more closely here, as the markets had topped off and began to drop in early 2008, gold had actually gone up at that same time. And so there was a lag between the drop in gold and the drop in the stock market. But also, if we look at the recovery, gold actually recovered before the stock market recovered. So it doesn't really give clear signals. Also over here, you know, we've seen rises in the stock market and a drop in gold, but then over here, the rise in stock market has been associated with a rise in gold. So again, no clear pattern that can help us look into the future. So let's have a look at this chart, which shows the Federal Reserve balance sheet in blue versus the gold price. Now, in the early 2000s, the balance sheet was rising, but at a relatively slow pace, whereas in contrast, gold was rising quite rapidly. Then we had this massive injection of money printing over here in 2009, and gold price also rose over that time. But interestingly, if we look over here in 2013, although the balance sheet had increased dramatically, gold price was actually decreasing with quantitative easing. So again, no clear pattern here that gives us an indication of what further QE in the future will do. The other thing that we can look at is things like central bank purchases of gold. So here we have a chart going from 1971 to 2016, and we can see that over the past few years, central banks have been net purchasers of gold at the highest levels in decades. So what does this mean? Because of course over this period gold price has actually been dropping, which again is very counterintuitive, and so it doesn't really give us an indication of future gold prices here. I wonder if this actually represents the accumulation phase. So if we look at stages of a bubble, in the early stealth phases, the smart money is accumulating the asset. And then the next stage is when institutional investors get involved. And then the final mania phase is when the public get involved. So is this what's going on? Very difficult to tell. Let's say the bearish case is true and we get sub $1,000 gold. Well, the reason for buying gold is really important here. If gold prices do go that low, then I think there's a very high possibility that you won't actually be able to get physical gold if that's your goal. This has occurred in the past. So, for example, this is a headline showing how there was a shortage of physical gold from the US Mint in 2009. Similar shortages from mints around the world were also reported in 2013. And of course, if we look at the gold chart from those times, those were when prices were low. Also at those times, just because the spot price is low doesn't mean the cost of buying the physical gold will be close to the spot price, because of course the premiums do vary according to the availability of the physical metal. And so even if you were able to get hold of physical gold at these lows, the premiums were actually significantly higher, and so it's not actually that different from buying at higher prices. So, as we can see, there are lots and lots of fundamental factors to consider, and the thing is, nobody knows all of the factors that are involved, and many of the things that occur are counterintuitive, so logic doesn't always help us. And so that's why I prefer to look at the technical side of things. I think the fundamental aspects are valuable, but only on longer timescales. So on shorter timescales, I find it very difficult to ascertain what's going on. So what is the bullish case for gold? So this is the monthly chart of gold in US dollars. So we'll start with this long-term trend line, which has been held in place for decades now. We've had this uptrend with the trend line tested a couple of times. We've had a 6-year bear market, which has resulted in a consolidation to form this triangle pattern. And we've had an upwards breakout that's been quite decisive. And this breakout and the size of this triangle gives us an upside target in the region of $1,700. Now, of course, we're only about halfway there, and there's nothing to say that, yes, we definitely have to reach that target. It doesn't always occur that way. And so there are a few things that can happen. But in terms of the highest probability, we're looking at price consolidating in this area. So we can either get sideways movements before the upward move, or price can pull back before making the target. But we don't know which of these is going to occur. The other possibility, of course, is that price could dip down, and this could be a false breakout, and price could nosedive. Let's have a closer look. So this is the gold US dollar spot price on the weekly scale, and again we can see this triangle here. We've also, within the triangle, we've got this smaller uptrend over here, and the reason for being still bullish is that we've got higher highs and higher lows in place, and so until that's violated, we have to assume that we are in a bullish uptrend. So, as I mentioned last week, we have this confluence of support in this area here. What I there are a few scenarios of where price could go. My sentiment is that I suspect price is going to go to at least $1,400. From there, it could either move sideways or drop further, but I would expect price to hit this trend line before making its next move up to the $1,700 level. I think there is a very low probability that price is going to breach this red support line here. Of course, nothing is 100% certain in the markets. If anyone tells you it is, don't believe them. There's no such thing as a dead cert here. So we've also always got to consider, when would I be wrong? And I would be wrong on the bullish case if price dips below this red line, which is at around the $1,360 level. So if price drops below this line, then the probability of the bearish scenario increases, and it would increase dramatically if we drop below this line over here. So that's below the base of the triangle here. And if we drop below this, then yeah, there's a high probability that we're going to look at sub $1,000 gold. But I think the chances of this happening are pretty low. But I can't say for certain. We have to keep watching, because the market will tell us what it wants to do, and so we have to use these lines as clues of where the market's going. So in the coming weeks, as I said, I expect price to go to at least 1,400, and at the lowest point would be the 1,360 level, followed by a bounce upwards. So let's wait and see what happens. I think the main takeaway point from this is that, first of all, fundamentals are very difficult to analyse, and technical analysis gives us some really helpful clues to tell us when we are correct and when we are wrong. So thanks for listening, and don't forget, there's no such thing as a dead cert, only probabilities. See you next week.